One of the key advantages of electing S-Corp status for your LLC or corporation is the ability to take S-Corp distributions. These distributions represent the company's profit that are passed on to the owners or shareholders, and here's the best part, they aren't considered wages. This means that they aren't taxed like wages, allowing you to benefit from a significantly lower tax rate on distributions compared to salaries. Now, while the S-Corp can help you reduce your tax liability, it only works if you know how to use them properly. In today's video, I'm going to break down how S-Corp distributions work, how to take them, and how they're taxed so you can keep more of your hard-earned money. Stick around because some of the things I discuss in this video you'll likely haven't heard before, especially from your accountant. And by the way, if it's your first time watching and you're wondering, who is this guy? My name is Navi Miraj. I'm a CPA and tax strategist who helps entrepreneurs like you save thousands of dollars in taxes through smart strategies like S-Corp distributions. I share valuable content right here on social media and through my course, which you can learn more about on my website at navimirajcpa.com. But for now, let's continue with today's topic. So what exactly is an S-Corporation? An S-Corporation is a tax status that can be elected by LLCs or even C corporations, and they help you reduce your tax liabilities, but only if you use them correctly. By default, LLCs are taxed as either sole proprietorships or partnerships, which means all of the business's profit are subject to both self-employment taxes of around 15%, as well as your federal and state income taxes. However, with an S-Corp election, the business is structured differently for tax purposes. In an S-Corp, the business must pay its owners a reasonable salary for their work. This salary is subject to self-employment taxes of the 15%, as well as federal and state income taxes. However, after paying the salaries, any remaining profit in the business can be distributed to the owners as S-Corp distributions, which are not subject to self-employment tax, only income tax. So let's break down how the tax benefits work. You have reasonable salary, okay? This is compensation paid to owners for the work they perform, which is, again, subject to both income and self-employment taxes. But then you have the distributions, the business profits distributed to the owners after the salaries are paid, and those are only subject to income tax. Hopefully you're able to understand what's happening here. The main advantage is that while the salary is taxed as usual, distributions avoid the 15% self-employment tax, resulting in potential tax savings on the portion of the profits taken as distributions. Okay, let's talk about S-Corp reasonable salaries. Before an S-Corp owner can take any distributions, the IRS requires that they pay themselves a reasonable salary. Now, the term reasonable salary is deliberately vague, and the IRS doesn't really define it that well, but it's based on the industry that you're in and the roles that you partake in your business. The general rule of thumb is that you should pay yourself the same wage you would offer someone with a similar role and experience. If you want more details on how that works though, check out some of my other videos on this topic. For example, the video entitled How Much to Pay Yourself, and it covers the reasonable compensation myths, can clear up some confusion that you may have. In fact, in the comments in that section below, you see people saying, hey, I've been begging my accountant for this information and for them to explain this to me, and they haven't done it. I'm so happy to have watched your video. Okay, so what are distributions and how do they benefit you? We kind of went over this a little bit a moment ago, but let's hit it up again. Distributions represent the profits of the business that are passed on to the owners or shareholders. One of the biggest advantages of S-Corp distributions is that they are taxed at a lower rate than wages. This structure allows owners to withdraw profits separately from their salary and at tax rates that are more advantageous. When it comes to distributions, S-Corps must allocate them based on an ownership percentage, which is determined by either the purchase of the shares or the terms outlined in the company's operating agreement. So here are some key points to remember about distributions though. Technically, you should not be taking distributions unless you've already paid yourself a reasonable salary for the year. Number two, you don't have to pay yourself a reasonable salary if you haven't taken any distributions. That's one that a lot of people don't realize. Number three, if you elect to forego taking a reasonable salary and distributions for, let's say, multiple years, that's actually okay. But when you decide to finally take the distributions out, you must sort of kind of play catch up with your reasonable compensation that you didn't pay yourself in the previous years. I discussed this in depth in my reasonable compensation video, so be sure to check that video out if you want to understand and take a deeper dive into that topic. So next up is, how are these S-Corp distributions taxed? Well, your reasonable salary will be subject to both payroll and income taxes, right? We've touched on that a few times already. Payroll taxes, which fund Social Security and Medicare, are taxed around 15%. However, since distributions are considered business profits rather than wages, they aren't subject to payroll taxes. This presents a valuable opportunity to save on taxes. While it may be tempting to reduce your salary to take more in distributions, you got to be careful here. If the IRS determines that you've underpaid yourself to sort of boost up your distributions, you could face penalties. And not only that, but back taxes and payroll tax liabilities on those distributions. Next up, you might want to know how to report your S-Corp distributions. Okay, so to ensure everything is properly reported, your distributions will need to be documented on your annual tax return. This is done via what's called a Schedule K-1. And that Schedule K-1 outlines each shareholder's profits or losses for the tax year. You'll also file a W-2 for your salary and Form 1040 for your personal tax return. Additionally, the S-Corp itself must file Form 1120-S, which reports the company's income, gains, losses, and deductions. And trust me, I know, hearing all of those tax forms may seem like an information sort of overload and can be quite overwhelming. But if you want to understand how S-Corp taxes work, watch my video specifically on this topic where I walk you through the tax forms step by step so you can gain a better understanding. So the next question you might have is, how much should you take in S-Corp distributions? There's no sort of hard and fast rule on how much to take in distributions, but it must be allocated based on ownership percentages. Before you take any distributions, the IRS requires that you pay yourself a reasonable salary. If your business doesn't have enough funds to cover a reasonable salary, you cannot take distributions. A common yet incorrect business practice is the 60-40 rule, which really isn't a rule because it's false, right? But the way this works is 60% of your revenue is allocated to salary and 40% to distributions. However, this rule is arbitrary and should not be used to justify your salary and distribution ratios to the IRS. Let's look at two examples of how S-Corp distributions work. Okay, so for example one, let's say you own 40% of an S corporation and you own that with 3 other shareholders who each own 20%. And your S Corp has $500,000 in net profit. And after paying the reasonable salaries to everyone, there's $196,000 left over for distributions. Each of the shareholders with 20% ownership will receive $39,200, while you will receive $78,400 because you remember you own 40% while the other shareholders own 20%. Now, for example 2, let's imagine you're the sole owner of a marketing S-Corp with a net profit of, let's say, $90,000. If the reasonable salary for someone in your position is $110,000, you wouldn't actually be able to take any distributions because your salary hasn't been fully paid yet. This is why it's important to understand what your reasonable compensation is and what your business profit is prior to making the S-Corp election. If you make the election prematurely, the S-Corp will end up costing you money instead of saving you money. And if you're looking for how to calculate sort of the break-even analysis for your S-Corp, check out this video entitled When to Switch from LLC to S-Corp as I go through sort of the break-even profit analysis when you're kind of doing that math for your specific business. As I mentioned earlier, I teach entrepreneurs just like you how to save thousands of dollars in taxes. Imagine joining students like Daniela, who saved over $30,000 in her first year, or Jeff, who's now saving over $25,000 annually, or even Valerie, another student saving over $10,000 in just the first year of implementing these strategies. And there are plenty of other use cases where students have saved $11,000, $6,000, and even $4,000 in their very first year of business alone. And the reason these results are possible is due to sort of a unique 3-step process that I developed that really helps you unlock those tax savings, okay? First, what you do is you build a strong foundational understanding of business taxes and accounting fundamentals. And so you know exactly how your business should operate, what a profit and loss statement is, what a balance sheet is, all those little things that you think you might know right now, but you don't really have a great understanding of. I teach that in the first sort of section of the course. Then you'll learn the powerful tax strategies, and nothing is held back. You'll discover how to save thousands with an S corporation, hire your minor children to save on taxes, and even contribute over $60,000 to your retirement accounts. Finally, you'll implement these strategies with me, step by step, side by side, using QuickBooks Online, ensuring that you save every dollar possible. And here's the best part. Most students complete the course in just a few weeks, and you could even be on your way to massive tax savings in less than 30 days. Whether you're a brand new entrepreneur or running a business over $1 million in revenue, the course is designed to help anyone. Plus, I offer a 30-day money-back guarantee with no questions asked, so all the risk is on me. So if you're ready to start implementing those strategies and saving thousands of dollars, such as how to actually properly do this whole S corporation distribution thing, visit my website at navimuradcpa.com or click the link in the description below to learn more and preview the course content. That said, let's recap some of the takeaways from this video about S Corp distributions. Electing S Corp status allows business owners to take advantage of tax savings by separating salaries from distributions, right? S Corp owners must pay themselves a reasonable salary before taking those distributions, and the IRS may penalize those who don't comply. A properly structured distributions can offer significant tax savings compared to wages. And electing S Corp status prematurely can cost you money instead of saving you money. So if you learned something that was valuable in this video, subscribe to my channel and click on that notification bell to be alerted when the next video is released. Or if you want to learn more right now, click here to watch another one of my valuable videos, and I'll see you either in that video or in the course.